Before we get into this, stay with me until the end, because the last number I'm going to show you is the one that changes how you think about every dollar you'll ever invest. And if you leave before that part, you'll miss the piece that actually matters. Picture someone standing in front of their laptop at 11 at night, scrolling through a brokerage app, watching a portfolio that was worth $40,000 a year ago, now sitting at $26,000. And there's this quiet, sinking feeling that isn't really about the money anymore. It's about the sense that somewhere along the way they missed something obvious, some number or ratio that everyone else seemed to understand instinctively while they were just buying whatever felt exciting at the time. That feeling of being one step behind, of reacting instead of understanding, is more common than almost anyone admits. And it usually isn't caused by bad luck or bad timing. It's caused by never having learned the small set of numbers that actually describe what an investment is doing underneath the price. Because here's the core concept worth sitting with. The price of an asset is not the same thing as its value, and almost every emotional swing an investor feels comes from confusing the two. Price is just what people are willing to pay in this exact moment, shaped by mood, news, fear, and momentum, while value is something quieter, built from earnings, growth, debt, and cash flow. The actual mechanics of whether a business or asset is becoming more or less capable of generating money over time. The investors who stay calm during crashes and don't panic during rallies aren't smarter or luckier. They've simply trained themselves to look past the price and toward the handful of numbers that reveal what's really happening. Psychologically, this matters because human beings are wired to react to movement, not to structure. Our attention naturally locks onto what's changing fast. A stock dropping 10% in a day feels urgent and threatening, while a company quietly increasing its earnings by 8% a year feels boring and easy to ignore, even though the second thing is usually far more important to your long-term outcome than the first. This is why so many people end up trading out of anxiety, selling right as prices fall, and buying right as prices rise, essentially paying attention to noise while ignoring signal. And the antidote to that pattern isn't willpower, it's literacy. Because once you understand what a number actually represents, it stops triggering fear and starts triggering context. So let's walk through the math slowly, because these are the numbers that quietly separate confident investors from anxious ones. The first is the price-to-earnings ratio, which tells you how much you're paying for each dollar a company earns. So if a stock trades at $50 and earns $5 per share annually, its P/E is 10, meaning you're paying 10 times earnings for ownership. And historically, the broad market has averaged somewhere between 15 and 20. So a company trading dramatically above or below that range is telling you something, either that investors expect extraordinary future growth or that they're worried about serious underlying problems. The second number is the expense ratio, especially for anyone investing through funds rather than individual stocks. And this one is deceptively powerful because it operates silently in the background. An expense ratio of 1% versus 0.1% sounds like a trivial difference, but compounded over 30 years on a $100,000 portfolio growing at 7% annually, that difference alone can quietly consume tens of thousands of dollars in fees, money that simply evaporates rather than compounding on your behalf, which is why so many long-term investors obsess over minimizing this one seemingly small figure. Third is diversification, often measured informally through correlation, which describes how closely two assets move together. If your entire portfolio is filled with assets that all rise and fall in the same direction at the same time, you don't actually have diversification. You just have one large concentrated bet wearing several different disguises. And true resilience comes from holding assets whose movements don't mirror each other, so that when one part of your portfolio struggles, another part can hold steady or even rise to offset it. And the fourth number, the one most people underestimate the most, is the real rate of return, meaning your return after subtracting inflation. An investment that grows 8% in a year sounds strong, but if inflation that year runs at 4%, your actual increase in purchasing power is closer to 4%, not 8%. And this distinction matters enormously over decades, because an investor who only tracks nominal returns can feel wealthier on paper while barely gaining any real ground at all. Now, zoom out for a moment because these numbers don't exist in isolation. They exist inside a much larger financial system that is, in a very real sense, built on the assumption that most people won't look closely enough to notice them. Fund managers are compensated whether their fund performs well or poorly. Financial media is incentivized to create urgency because urgency drives engagement, and entire product categories exist specifically to sound sophisticated without necessarily being useful to the person buying them. This isn't some grand conspiracy. It's simply the natural outcome of a system where attention and simplicity are rewarded more than quiet, accurate analysis. And the numbers we just walked through are the tools that let you see past that layer of noise into what's actually happening with your money. Which brings us to the deeper shift, the one that matters more than any single ratio. Because understanding these numbers isn't really about becoming a spreadsheet person or memorizing formulas. It's about becoming someone who responds to markets instead of reacting to them. Once you can look at a falling stock price and immediately check whether the underlying earnings have actually changed, you stop being someone who gets pushed around by headlines and start being someone who evaluates evidence. And that shift in identity, from reactive to analytical, tends to ripple outward into how a person handles risk, uncertainty, and decision-making far beyond investing itself. None of this requires predicting the future or outsmarting the market. It simply requires paying attention to the numbers that were quietly available the entire time, sitting underneath the price, waiting to be read by anyone willing to slow down long enough to look. That quiet kind of literacy, built slowly and applied consistently, tends to outperform excitement and urgency almost every single time. Not because it's flashy, but because it's grounded in something real. If this helped you see investing a little differently, take a second to like the video and subscribe, because there's a lot more where this